You could earn six figures for the next 10 years and still be less likely to retire a millionaire than a teacher quietly investing $500 a month. If you don't understand why your savings rate matters more than your salary, you don't understand why only 8.8% of Americans ever become millionaires. That's the real number right now, according to Federal Reserve data. About 1 in 11 adults. Not 1 in 3, not 1 in 5, 1 in 11. And here's the part that trips almost everyone up. Most of them were never big earners. Engineers and teachers show up in this group more often than bankers and entertainers do. So if income isn't the deciding factor, what actually is? Today we're breaking down exactly why so few people cross that seven-figure line and the one habit that quietly separates the 8.8% from everybody else. Meet Jake. He's 31, married, living in Kansas City, Missouri, and working as a mechanical engineer. 3 years ago, Jake got the raise he'd been chasing for 2 years straight, an extra $14,000 a year, effective that February. For about a month, he actually meant to put most of it straight into his 401k. Then a new truck happened, because his old one hit 200,000 miles the same month the raise landed. Then a bigger apartment happened, because why not? They could finally afford it. Then a family trip to Florida happened, because they'd earned it, hadn't they? Even his wife Rachel remembers saying, "We deserved this" more times that year than she'd like to admit. Nobody was being reckless. It just never felt like the moment to say no. By the time the dust settled that December, Jake's 401k contribution had gone up by exactly $20 a month. 20 out of 14,000. Be honest. Have you ever gotten a raise and had almost nothing to show for it a year later? What year did that happen for you? Drop it in the comments, because I guarantee you're not the only one. And hey, if you're new here, go ahead and subscribe now, because we're about to find out exactly where that $14,000 actually went and where it could have gone instead. Here's the thing. Jake isn't undisciplined, and he's not bad with money. He's completely normal. According to research from the Millionaire Next Door, the strongest predictor of ending up a millionaire isn't your income at all. It's the ratio between your net worth and your income, tracked over decades. And according to that same Federal Reserve data, 88% of American millionaires built their wealth themselves, mostly through ordinary saving and investing, not inheritance and not luck. There's a second number worth knowing too. About 94% of millionaires point to the exact same habit behind it all. Consistently living below their means, year after year, long before they had real money to show for it. There's also a time factor most people miss completely. The typical American who eventually reaches $1 million doesn't get there until around age 50. That's not a lack of talent. That's decades of small decisions, compounding quietly in the background, long before the number ever shows up on a statement. That might sound backwards, but it makes sense once you think about it. A steady paycheck from an ordinary career is actually easier to build a consistent savings rate around than a volatile, high-flash income that swings up and down with bonuses, tips, or a good year in sales. Consistency beats intensity almost every single time. Now compare that to what actually happens to most raises. Financial researchers who've studied this keep landing on a similar range. Somewhere between 50 and 70% of a typical raise gets quietly absorbed into lifestyle upgrades within the first year. And it's not just lower earners. A 2024 survey found that 36% of Americans making over $100,000 a year are still living paycheck to paycheck. 6 figures and still paycheck to paycheck. Think of your income like water filling a bucket. If the bucket already has a hole in it, a truck payment, a bigger lease, a subscription you forgot you're paying for, pouring more water in just makes the leak faster, not the bucket fuller. And nobody sends you a notification when that hole opens up. The auto industry knows this. The average new car loan right now runs close to 7%, according to Bankrate, on a payment most people never actually shop around for. The rental market knows this. Even your credit card issuer knows this. Here's a stat that shows just how deliberately this is built. A 2026 industry survey found 59% of people earning over $100,000 a year have used a buy now, pay later service. Not the lowest earners, the highest ones. These products are built to catch money exactly where it lands, before you ever get the chance to redirect it somewhere that actually compounds. If this is already making you rethink your last raise, go ahead and tap that like button. It takes 1 second, and it helps a lot more people actually see this. So Jake did what most of us would do. He decided the fix was simple: earn even more. He picked up overtime for 8 months straight, pulling in an extra $600 a month before taxes. And for a while, it genuinely looked like it was working. The numbers on paper looked great, except it wasn't working at all, because that overtime money went straight into the exact same leaky bucket. A few more takeout orders on the nights he was too tired to cook. A couple of upgrades around the house he told himself he'd earned. A slightly nicer car lease, since he was making more now anyway. At the end of those 8 months, Jake had worked roughly 280 extra hours, nights, weekends, missed dinners, and his actual savings balance was higher by less than $400. Break it down, and that's less than $1.50 an hour of real, lasting benefit for all that extra time on the clock. Even though the overtime pay itself looked completely different on paper, working harder hadn't fixed the problem. It had just given the problem more to eat. Here's a number that's about to mean something completely different in about 60 seconds. If Jake had redirected just that original $14,000 raise, the whole thing, not the $20 extra a month he actually saved, into a Roth ERA and his 401k, and kept contributing that same amount every single month going forward, here's roughly what it could look like, assuming a historical stock market average return of around 9% a year. In 5 years, that could put him close to $90,000. In 10 years, based on those same assumptions, it could be sitting around $225,000. By year 15, it could realistically be approaching $440,000. And by year 20, this is the one that stings, it could be closing in on $800,000. Now here's the part that really changes how you think about timing. If Jake had made this exact same decision 6 years earlier, at 25 instead of 31, that same monthly amount, compounding for 26 years instead of 20, could realistically be worth around $1.45 million by that same age. Nearly double, from 6 extra years and no extra dollars. One raise, properly redirected and left alone to compound. That's most of the way to becoming one of that 8.8% off a single decision made 3 years ago from a guy who never once changed his salary. There's a name for exactly what happened to Jake, and to most of us. It's called present bias, a well-documented pattern where people consistently overvalue a reward available right now compared to a much bigger reward available later, even when the math clearly favors waiting. Behavioral economists sometimes call the sharper version of this hyperbolic discounting, and it shows up in almost every spending decision we make, not just the big ones. Companies know this about you, and they price around it deliberately. That's why financing a truck feels like nothing, $60 a week, while committing that same $60 a week to a Roth IRA feels like a genuine sacrifice, even though it's the exact same number leaving your account either way. It's the same reason a streaming subscription auto-renews silently every month, but moving that same $10 into an index fund feels like a decision you have to keep making. One is designed to be invisible. The other one isn't. Yet, car dealerships and real estate agents have gotten good at spotting exactly this moment too. A new job title, a promotion announcement, even a public salary band posting can trigger targeted offers within days. Not because anyone's watching you personally, but because raises cluster around review season. And review season is exactly when financing pushes get loudest. Even your own 401k plays into this. Most plans now auto-enroll you the moment you're hired at a small default percentage, and most people never touch that number again in either direction. The default becomes the ceiling, not the floor. The immediate reward is loud. It's tangible. You can drive it home the same afternoon. The compounding reward is silent for years, completely invisible, right up until the moment it isn't. And by then, most people have already decided investing just isn't for them. Quick reminder, This video is for educational purposes only and is not financial advice. Check the description for full details. Now, here's what actually changed for Jake once he saw his own numbers laid out like this. I'll be honest with you. I actually ran this same test on my own last raise before I trusted it enough to put in this video. And the number was almost identical to Jake's, 20-some dollars a month out of a four-figure increase. So the first thing Jake did was flip the order completely, using something planners sometimes call the raise rotation. At least 50% of any future raise or bonus now gets redirected before it ever touches his checking account. First into his 401k up to his employer's match, then the rest into a Roth IRA. For 2026, that Roth IRA can hold up to $7,500 a year if you're under 50. Plenty of room for most of a typical raise before you'd ever need to think about where the rest goes. And if your employer offers any kind of match, say 50 cents on the dollar up to 6% of your salary, that match alone is an automatic 50% return the moment it lands, before the market does anything at all. Skipping that match to keep more cash on hand is one of the most expensive decisions you can make without ever seeing a bill for it. The money is gone before lifestyle creep even gets a vote in the matter. This works the same way with a bonus, a tax refund, or a side gig payout. Any lump sum landing outside a regular paycheck. The moment it hits before it sits in checking for even a week, move that same 50% over. Money that sits untouched for a few days has a way of quietly becoming a coffee run, then a nicer dinner, then nothing left to move at all. The second thing was smaller than you'd expect. He started tracking one number every quarter on the same day each time. Net worth divided by income, instead of just watching his paycheck get bigger. And the third thing is the one I actually want you to do right now. Not later tonight, not tomorrow. Pause this video, open your banking app, and check what percentage of your last raise actually made it into savings. Whatever that number is, that's your real starting point. Not your salary, not your job title. Your savings rate is the only number that's ever actually decided who ends up in that 8.8%. At the end of the day, the raise was never really the problem. It's what happens to it in the 30 days after it lands that decides everything. 8.8% isn't a ceiling. It's just how many people have found the one lever that actually moves the number. If this shifted how you think about your next paycheck bump, hit subscribe. I break down one real number like this every single week. One more thing, if you haven't caught the $84 trillion wealth transfer, 90% of it won't survive yet. That's a perfect follow-up to this one. Keep pushing forward, stay disciplined, and I will see you in the next one. Growbit US.